Stocks sell at silly prices from time to time. It doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act that day. This is said by the most famous and world's best investor, Mr. Warren Buffett. The 92-year-old, who is the CEO of Berkshire Hathaway, one of the largest companies in the world. Now, every year, he releases a letter to his shareholders detailing the returns of Berkshire Hathaway stock since he took the reins back in 1965, and get this, from then to now. He's averaged 20.1% per year, while the S&P 500 or the market has only averaged 10.5%. Berkshire's total return over that time is 3.6 million percent versus 30,000% of the S&P 500. So in this video, we're going to go over some of Warren Buffett's advices that specifically applies to the investing scenario that we all this year. So what is that situation? Well, firstly, the market is falling. It fell 20% in 2022. We also have very high inflation. That does seem to be trending down, at least currently. And then finally, we have rising interest rates, which are likely going to continue in 2023. Based on the Fed reaffirming they want to get that inflation rate back down to 2%, and they won't stop raising rates until they get there. So, all that together with the possibility of a decent-sized recession throughout the year, and well, for investors, there's a lot to think about. So let's start with the first conundrum. What do we do as rational long-term value investors when the stock market is pretty solidly trending down? So market is down almost every other day. It is concerning for you as an investor, but in actual, that's good for you. If you are a net buyer of stocks over time, so when stocks are down, you're going to be buying on balance, and who wouldn't rather buy it? Buffett's rational thinking really shines through when he touches on the fact that most people's reaction to a falling market is really emotional. People just feel better buying stocks when the market is going up, but in reality, you should actually feel better buying at times like right now, when the stock market is down so much. And this goes back to a very famous investing quote which says, "The stock market is the only place people run out of the store during a sale." Think about that when it's Black Friday. We're always buying, but how come we get scared when Black Friday happens in the stock market? For long-term investors, we should actually get excited by the stock market falling. Buffett also said in one of his interviews that some people should not own sites at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. Warren warned that if you can't take your stock going, which is going to go down sometime, then don't own one. If you own a stock, so why worry about it? The point is to buy something that you like at a price you like, and then hold it for 20 years, and you should not look at it day to day. So in summary, own great businesses, and remember that market corrections are a normal part of investing, and they should actually make you happy, not scared. So that's investing during a bear market, but what about all this inflation? We're seeing prices of materials are rising a lot, at the moment making everything more expensive for both consumers and also for businesses. So what do we need to consider during a period where prices across the board are inflating? So Buffett's advice about this scenario is really interesting, and there are a few concepts to unpack there. Firstly, the best thing you can do during high inflation is to actually improve your own earning power. Okay, make yourself more valuable to your employer or potential future employers so that your income can actually rise alongside the inflation that you'll feel, but beyond that. Buffett says the best passive strategy you can implement to nullify inflation is to find a really high-quality business and stay invested in it. And Buffett wrote down exactly what he meant by this back. In his 1981 shareholder letter, he said that the best businesses to own to combat inflation have firstly an ability to increase prices rather easily, even when product demand is flat and capacity is not fully utilized, without fear of significant loss of either market share or unit volume. And then two, he said, they need to have an ability to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, with only minor additional investment of capital. So, to explain, Buffett is simply saying that businesses will fare better during inflation if they are scalable, aka they can accommodate a much higher dollar volume of business without needing to sink a lot of money into the company. So, when it comes to investing during inflation, the business needs to have an ability to increase prices without losing market share or unit volume, and this simply means that the company has a competitive advantage or a moat that gives them pricing power. Just like no one would prefer a new chocolate over Snickers, no matter what the price, same like the people that have an iPhone. They want to continue with the product that they've got. You need a moat. As Buffett said, powerful brands like Coca-Cola or Apple or Louis Vuitton, they all have moats. Costco's built a motor around always having the best prices. There are a lot of different ways companies can form a competitive advantage, and if it gives them the ability to dictate prices, aka pricing power, then they're the best bets to come out on top during an inflationary period. As inflation raises their costs and lowers their profits, they can simply raise the prices of their end products, and their moats should protect them from suffering a drop in sales. In fact, last year, as Coca-Cola raised their prices, their sales actually went up. So there is some good proof for you. So that's how to handle the inflation side of investing in 2023. But finally, we also need to talk about the third big challenge of investing this year: interest rates. What can we do when interest rates just keep rising? Interest rates, basically are the value of assets. When interest rates are very low, it makes money cheap and easy to access for both consumers and businesses. And this means more spending, more profits, and more growth, and that's what we've had. Now we're starting to see rising interest rates. This means, of course, borrowed money is more expensive to access. So, business debts become harder to pay off, and consumers generally have a lot less to spend. So, this is a tough environment for businesses to operate and thrive in, and often shows in their financial results, which then affect their stock prices. Have a look at this graphic of the past 5 years. As you can see, interest rates went up in 28%, 18%, and the stock market didn't do much at all in 2019. Rates started coming down, and the market went up, and then when covered struck, the Fed lowered the interest rate to zero, and the market basically boomed for 2 years. However, in 2022, interest rates went up a lot, and the market dropped by 20%. So, when rates go up, stocks generally suffer, and this is half caused by businesses performing poorly and their stock value falling. But the other factor to consider with interest rates is, of course, government bonds. So, US Treasury bills or Treasury bonds are generally considered the risk-free returns. So, you give the US Treasury a loan, and then they'll pay you back at some point in the future, plus interest. So, when interest rates are low, the government gives you bigger interest, but when interest rates rise, if you buy the new bonds that they're issuing, they will give you a higher interest payment. Now, this is very interesting to the 80% of the market who are just institution money managers, trying to get a good return for their clients with as little risk as possible. So, what you find is that when rates rise, a lot of professional money flows out of the risky stock market and back into the safety of treasury bills, and that selling out of the stock market by the big players causes stock prices to fall. This is Buffett talking about exactly this idea in 1982 or 3, advising people to stay focused on the long term because history tells us stocks are generally a better place to be than bonds. Over a very long period of time, that's just the reality. But for short periods of time, well, occasionally they're not. So you as stock market investors need to stay focused on the long term so that we can use the depressed stock prices on high-quality businesses as opportunities for long-term returns. We need to acknowledge that we can't do anything about the Federal Reserve. They'll do whatever. So instead, let's just play the long game and pick up great businesses at great prices while interest rates are really high. That's how we tackle a high interest rate environment. Hope you got something useful out of this video. Please leave a like and subscribe to support the channel. Thank you for watching, and see you guys soon.